In March 2020, two people in Phoenix, Arizona made the same decision for the same reason. The economy was collapsing in real time. The stock market had just lost 34% of its value in 33 days, the fastest bear market in recorded history. Both of them had spent decades building savings. Both of them were scared. Both of them were watching the news every morning and asking the same question: where do I put my money so it survives what is coming? And both of them moved a significant portion of their savings into assets they believed would protect them when everything else was falling apart. Marcus Webb was 54 years old, operations manager at a logistics company in Phoenix. 30 years of disciplined, consistent saving had built him $340,000 in total savings. He was not a reckless person. He was not a gambler. He was an engineer of systems who applied the same methodical thinking to his finances that he applied to his work. When the crash hit in March 2020, Marcus did what felt logical and obvious to him and to millions of people exactly like him across the country. He moved $95,000, roughly 28% of everything he had accumulated over 3 decades, into 3 things that felt solid, real, and permanent: a new truck, a luxury watch collection, a timeshare property in Scottsdale. He paid $48,000 for the truck in February 2020, $31,000 for the watches, $16,000 for the timeshare. These were not impulse purchases made in a moment of panic. Marcus had thought carefully about each one over several weeks. He had done research. These were things you could see, touch, drive, wear, and visit. Things that existed in the physical world independently of any stock market, any bank, any financial institution. Things that felt like they would hold their value regardless of what happened to the economy, the dollar, or the headlines. Sandra Okafor was 51 years old, freelance accountant. Same city, same crash, same fear, same instinct to protect what she had built. She had $280,000 saved. She moved $90,000 into 3 things: Gladstone Land Corporation, ticker LAND, a farmland real estate investment trust; short-duration treasury bonds through the Vanguard Short-Term Treasury ETF, ticker VGSH; and $15,000 in physical cash kept at home in a fireproof safe. Nothing glamorous, nothing you could drive to work or wear to a dinner party or show a neighbor with pride. Nothing that felt exciting or clever or sophisticated. Just 3 instruments chosen for one specific quality. They generate income and hold value when everything around them is collapsing. By December 2022, Marcus Webb had lost $45,000 on the $95,000 he had moved specifically to protect himself. His truck, purchased for $48,000 in February 2020, had depreciated to $31,700, a loss of $16,300 on an asset he bought as protection. His watch collection had dropped from $31,000 to approximately $19,000 after the luxury watch market peaked in November 2021, and the watch chart's overall market index fell 31% over the following 14 months. His timeshare was worth exactly 0. The company had filed for Chapter 11 bankruptcy. The $16,000 was gone entirely. Sandra Okafor's $90,000 had grown to approximately $123,000. Her farmland REIT returned 34%, including dividends, over that same period. Her treasury position added 3.1% annualized. Her cash position had lost nothing, because cash in a fireproof safe does not depreciate. Same crash, same city, same fear, same instinct. Marcus lost 47.4% on assets he moved specifically to protect himself. Sandra grew her protected position by 36%. The gap between them is not explained by intelligence or access or income. It is explained entirely by the difference between what feels safe and what the data shows is safe, and those 2 things are almost never the same thing. My name is Ban, and I spend way too much time going through crisis data, Federal Reserve records, consumer finance studies, insurance industry filings, and 100 years of depreciation analyses to track the same pattern that emerges every single time the economy turns. People move money into things that feel safe, and those things destroy them. Not because the people are reckless or stupid, not because they failed to think it through, but because they have never been shown what the data actually says about what holds value and what collapses the moment a genuine crisis arrives. The popular version of crisis protection is everywhere. The real version is almost never discussed honestly. We are going to go through 5 specific asset categories right now. Assets that millions of Americans hold today, assets that feel stable, tangible, and permanent. I am going to show you with exact figures, sourced from verified government data and independent studies, what happens to each one the moment the economy turns. If you own any of these, you need to see this before the next downturn, not after, before, because by the time after arrives, the buyers have already disappeared and the bankruptcy notices are already in the mail. The first asset is the one Marcus led with. New vehicles. The IC Cars 2023 depreciation study is the most comprehensive vehicle depreciation analysis in existence. It analyzed 8.2 million vehicles sold between 2018 and 2023. The findings are precise, and they apply to every vehicle on every driveway in America right now. The average new car loses 19.1% of its value in year one. Not at resale under adverse conditions, not in a weak market. In normal economic conditions, the average new vehicle loses nearly a fifth of its purchase price in its first 12 months of existence. By year 3, the cumulative depreciation reaches 34.1%. Over 5 full years, the average new vehicle has lost 49.1% of its original purchase price, nearly half, gone before any crisis has arrived. In a crisis, that depreciation accelerates dramatically, and the market for selling vehicles contracts at the same time. During the 2008 financial crisis, vehicles lost 25 to 35% of their value within 12 months as credit markets froze, dealership chains collapsed, and consumer demand for new and used vehicles evaporated. People who needed to sell their vehicles to raise cash discovered they could not find buyers at any price they would accept. Marcus paid $48,000 in February 2020. By the end of 2022, standard depreciation curves placed that truck at $31,700, a $16,300 loss on an asset purchased specifically as a store of value. Here is the mechanism that makes vehicles the most seductive trap on this list. A vehicle feels like an asset because it is large, expensive, physically present, and necessary for daily life. You see it every morning. You use it every day. It is real in a way that a brokerage statement is not. But it generates absolutely zero income while you hold it. It costs money every single month to insure, register, maintain, and fuel. And in a genuine economic crisis, when you need liquidity urgently, the resale market for vehicles does not decline gradually. It collapses. The dealers stop buying. The financing that supports private vehicle sales freezes. The person who was going to buy your truck next month no longer qualifies for the loan. What felt like a $48,000 asset sitting in your driveway becomes a $30,000 liability, with insurance due next month and registration due in the spring. But it gets darker. The second comfort asset carries a veneer of sophistication that makes it more psychologically dangerous than the truck: luxury goods, watches, and collectibles. The luxury watch market between 2020 and 2022 appeared to have become a legitimate investment asset class. The Rolex Daytona reached $49,000 on the secondary market in November 2021, a 210% premium above its retail price. Financial media ran serious analytical segments about watches as stores of value. Collectors who had bought years earlier were sitting on extraordinary paper gains. It felt like the intersection of aesthetic taste and financial intelligence. Marcus's $31,000 collection felt like a position in an asset class that was performing. By December 2022, the watch chart's overall market index had fallen 31% from that November 2021 peak. His collection was worth approximately $19,000, a $12,000 loss in 14 months. But the price decline understates the structural danger of this asset class. Unlike stocks, you cannot sell a watch collection in 30 seconds at market price on a Tuesday morning. You need an authenticated buyer. You need a functioning resale platform. You need someone on the other side of the transaction who actively wants what you are selling and has the discretionary income to pay for it. In a genuine economic crisis, all three of those conditions fail simultaneously. The collector paying $49,000 for a Daytona in 2021 is not paying $19,000 in a crisis. He is not in the market at all. He is worried about his mortgage. There is no bid. There is no floor beneath you. There is a beautiful object in a drawer that cannot be converted to anything you need at any price you would accept. The same structural pattern applies to art, vintage cars, wine collections, rare coins, and designer handbags. Every one of these asset classes is priced by discretionary consensus in good economic times. That consensus does not compress in a crisis, it evaporates entirely. And the person holding the physical object is left with something whose market has simply ceased to exist. Now here's where the data gets genuinely alarming. The third comfort asset destroys people who believed they were buying real estate: timeshares. Marcus paid $16,000 for a Scottsdale timeshare. He believed he was buying a fractional interest in a real property with real underlying value. The American Resort Development Association, the timeshare industry's own trade organization, publishes data that tells a completely different story. The average timeshare purchase price across the United States is $24,140. The average resale value is between $1,500 and $2,000. That is a 92% loss on resale in normal economic conditions, before any crisis, before any market stress, simply the normal outcome of buying a timeshare and later attempting to sell it through any legitimate channel. On top of that capital destruction, the annual maintenance fees average $1,120 per year. You are paying more than $1,000 every year to continue holding an asset that has already lost 92% of its purchase value and will lose everything that remains the moment any economic stress hits the resort industry. Between 2020 and 2022, 93 U.S. timeshare companies filed for bankruptcy according to ARDA's own data. Marcus's company was one of them. His $16,000 went to exactly zero. Not down 50%, not down 70%, zero. During 2008, timeshare delinquency rates hit 15.6%, and the secondary resale market froze so completely that even distressed sellers could find no buyers at any price. The pattern repeats without variation every crisis cycle. The fourth comfort asset targets the people who consider themselves too financially sophisticated to fall for trucks and watches. Cryptocurrency held as crisis insurance. The intellectual case for cryptocurrency as crisis protection has genuine coherence: fixed or limited supply, decentralized structure independent of any government or central bank, a hedge against monetary inflation and dollar devaluation. These arguments are not foolish. They are made by serious people with serious analytical frameworks. The data simply does not support the conclusion. Bitcoin fell from $69,000 in November 2021 to $15,500 in November 2022, a 77.5% decline in 12 months. Ethereum fell 81% over the same period. These collapses happened during a period of rising inflation, dollar uncertainty, and genuine economic stress, the exact conditions under which the crisis protection thesis was supposed to activate and protect holders. The crisis insurance did not activate. It fell faster and further than almost any other asset in the portfolio.
The structural reason this happens is straightforward and will not change. Cryptocurrency derives its entire value from network consensus and market liquidity. It has no underlying productive capacity. It generates no income. It produces no goods or services. When a genuine crisis arrives and people need cash to pay rent, service debt, and buy groceries, they liquidate what they can liquidate quickly. Cryptocurrency is highly liquid in normal conditions, so it gets sold first and hardest. And FTX's collapse in November 2022, which froze $8 billion in customer funds at the precise moment those customers needed liquidity most, demonstrated the additional custodial risk that sits beneath the market risk. The crisis insurance had become the crisis. The fifth comfort asset is the most dangerous on this list precisely because it looks the least like a comfort asset: large, uninsured cash deposits held at a single institution. The FDIC insures up to $250,000 per depositor per institution. Most people know this. Fewer people understand what the Dodd-Frank Act of 2010 actually created above that limit. The Orderly Liquidation Authority is a legal framework that allows the federal government to manage the failure of a large financial institution through a bail-in mechanism. In a bail-in, deposits above the $250,000 FDIC limit can be converted into equity in the failed bank. You become a shareholder in an institution that has just collapsed. In Cyprus in March 2013, depositors with over €100,000 at Bank of Cyprus lost 47.5% of their balances overnight through exactly this mechanism. Not through market movements they could have anticipated, through a government-administered restructuring that happened between Friday evening and Monday morning. Silicon Valley Bank failed on March 10, 2023, the second largest bank failure in U.S. history. $175 billion in deposits were frozen for 72 hours. The FDIC chose to guarantee all deposits above the limit in that specific case. That was a discretionary decision by regulators under political pressure. It was not legally required. The legal framework for not making that same decision the next time exists and is active. Anyone holding more than $250,000 at a single institution today is holding uninsured deposits in a system where the bail-in mechanism is legally established and has already been used in allied Western economies. U.S. consumer debt reached $17.5 trillion in the fourth quarter of 2023, the highest level ever recorded. Vehicle loan delinquencies of 90 or more days hit 2.96% in that same quarter, the highest reading since 2010. Credit card delinquencies reached 3.1%. These are not forecast numbers or projected risk scenarios. These are current readings from the Federal Reserve's own data. They are the exact categories of stress readings that preceded both the 2008 financial crisis and the 2020 crash. The sequence is familiar to anyone who has studied what the data looks like before a crisis rather than during one. The comfort asset trap runs through 4 phases in every single economic cycle without exception. Phase 1 is accumulation during good times. These assets feel valuable because the economic environment supports their prices, and social consensus reinforces the feeling. Everyone around you owns a truck. Everyone at the dinner party is talking about watches. The resort sales presentation is compelling. Phase 2 is the crisis trigger: a bank failure, a market collapse, a sudden unemployment spike. Phase 3 is the illusion phase. You paid real money for these things relatively recently. They still feel valuable because the purchase price is vivid in your memory. The truck still drives. The watch is still beautiful. The timeshare resort still exists in Scottsdale. The illusion can persist for months. Phase 4 is the realization. The market for these assets has not merely declined, it has ceased to function. There are no buyers at any price that makes the position feel acceptable. There is no liquidity. The bankruptcy notice arrives, the maintenance fee bill arrives for an asset worth nothing. The $45,000 loss crystallizes. Smandra spent 6 full months in Phase 3. He held every position because he had paid real money and he expected real value to return. Every month he held, the truck depreciated further. The watch market moved further from its peak. The timeshare company moved further through its bankruptcy proceedings. By the time he accepted the reality, the losses were larger than they had been on the day he first understood them. So, what does the data show actually works? What was Sandra doing that Marcus was not? Gladstone Land Corporation, ticker LAND, returned 11.5% annualized over 10 years and paid dividends every single month of that decade, including during the 2008 financial crisis and the 2020 COVID crash. Not quarterly, monthly. When the S&P 500 fell 57% in 2008, farmland as an asset class returned positive 6%. While Marcus's truck was depreciating and his watches were collapsing, Sandra's farmland position was generating monthly income and appreciating in value. The USDA National Agricultural Statistics Service data shows U.S. farmland has appreciated in 49 of the last 50 years. The single down year was 1986. This is not an exciting asset, it is a relentlessly functional one. The Vanguard Short-Term Treasury ETF, ticker VGSH, maintains near-zero default risk and stays fully liquid in any market condition, including the most severe credit freeze in the historical record. When every other market was seizing in October 2008, short-duration Treasury instruments held their value and remained convertible to cash within 24 hours. This is the asset you hold not because it will make you wealthy, but because it will still be there in its entirety when you need it. Sandra's Treasury position added 3.1% annualized through the entire 2020 to 2022 period, while Marcus's truck was losing $16,000.
The Consumer Staples ETF, ticker XLP, which holds Procter & Gamble, Coca-Cola, Walmart, Costco, and their equivalents, declined only 28% during the 2008 financial crisis compared to the S&P 500's 57% decline. People continued buying soap, cleaning products, food, and household essentials throughout the worst financial crisis in a generation. They stopped buying trucks, watches, timeshares, and luxury goods. XLP paid dividends throughout. It provides exposure to companies with real pricing power, real non-discretionary demand, and real earnings that continue through every economic cycle. The signal worth monitoring consistently is the University of Michigan Consumer Sentiment Index. When it falls below 65, it has historically indicated the presence or imminent arrival of significant economic stress. It crossed 65 in March 2020, June 2022, and October 2008, preceding or confirming each major stress event in the recent record. Available free at the Federal Reserve's FRED database under series UMCENT, updated monthly. When it crosses below 65 and holds there across 2 consecutive monthly readings, the urgency of this conversation increases substantially. Let me bring this back to where we started. Marcus Webb is still driving that truck. He eventually made his peace with the loss. The watches are in a drawer in his bedroom. He takes them out occasionally. The timeshare company sent a final bankruptcy notice confirming zero recovery for interest holders. He spent 2023 and 2024 methodically rebuilding his position, moving away from physical comfort assets and toward income-producing instruments. He is going to recover fully. He is a disciplined person, and discipline applied in the right direction will get him there. But $45,000 of retirement savings that took years to accumulate bought him nothing except an expensive education about the difference between what feels safe and what is safe. And it cost him years of compounding that will never come back. Sandra Okafor is collecting monthly dividend payments from her farmland REIT. Her short-duration Treasury position has performed exactly as the data said it would. Her $15,000 in cash sits in a fireproof safe and has cost her nothing to hold. She does not talk about her portfolio at dinner parties because there is nothing visually impressive to describe. There is no truck in the driveway that signals financial confidence. There is no watch on her wrist that announces good taste. There is just a spreadsheet that shows 36% growth on a position she built specifically to protect herself, and a complete absence of bankruptcy notices in her mail. Same crash, same city, same fear, same instinct to protect what decades of work had built. The outcome was not determined by intelligence or luck or access. It was determined entirely by one thing. Marcus had the popular version of the crisis protection playbook, and Sandra had the version the data actually supports. The comfort asset trap is not a new phenomenon. Every generation finds its own version of the physical, tangible thing that feels safer than financial instruments. In 1929, it was land purchased on speculation. In 1980, it was gold coins bought at the peak. In 2006, it was investment properties bought with no money down. In 2020, it was trucks, watches, and timeshares. The instruments change. The four-phase trap runs identically every time, and the people who avoid it are not smarter than Marcus Webb. They simply saw the data before the crisis arrived instead of after. If this changed how you think about what you currently own, share it with one specific person today. A spouse who is about to buy a new vehicle because it feels like a safe store of value. A colleague who is putting money into collectibles because they feel more real than stocks. Someone who is about to move retirement savings into a physical asset because the market makes them nervous. The trap is running right now. The Phase 3 illusion is active for people across the country. They paid real money, they expect real value to return. Some of them will wait for years before the realization arrives. Hit subscribe. Every week we go deeper into the historical data and the specific patterns that repeat in every crisis. Exact names, exact figures, exact dates. The version that actually works. This is Ban. Stay sharp out there.